This period now, I think by next year, we're back at all-time highs. And so it is different. It's just the initial emotional reaction will be the same, but then gold should head back to new all-time highs. 5K next year to me is a no-brainer.
It looks to be after probably January next year. In most of these cases, you're looking at basically a 3 month, consolidation type thing. But our computer's showing war next year. Just keep that in mind that it's not going to crash and go back down to 2000 or something like that. I don't see that. In order to do something like that, you'd have to have really peak.
Gareth Soloway and Martin Armstrong outline a critical transition phase for gold, one where short-term emotions disguise a far more substantial, long-term structural shift. Their combined view suggests that the current consolidation is simply the reset before acceleration, with both analysts pointing toward a return to all-time highs by next year. The logic is rooted in historical rhythm. After major impulsive rallies, gold typically compresses for 2 to 3 months before launching into its next leg. With geopolitical pressure rising and Armstrong's models flagging an elevated conflict risk in the coming year, the macro environment increasingly favors the strength of hard assets rather than a retreat to the old $2,000 levels. In this framework, $5,000 gold isn't a stretch, it's the logical extension of the cycle. The current softness is a preparation, not a reversal, and the long-term charts support a renewed breakout as early as the first quarter. If you found this analysis helpful, make sure to hit that like button, share it with fellow investors who follow gold and silver, and subscribe so you don't miss the next big update.
I personally think there's a little bit more downside to gold. I'm still, listen, I have a huge amount of gold that I bought for a long-term portfolio that I'm going to hold, and I'm going to keep holding that regardless. But I'm also a swing trader, right? So I'm looking to see, okay, where could it pull back to? And one of the things we saw is we saw this top back in October, this first retrace, a big bounce, and it stalled out right in here, and now it's starting to come in. And I'm going to show you something here. This is a really, really cool chart on gold. This is the 1979 versus 2025 chart, and it's almost identical. So in 1979, we had this first bull move, and then we had this sideways consolidation. In 2025, we had this first bull move and sideways consolidation. We then in 1979, starting right here, 9 straight up candles in a row on the weekly, so 9 weeks up in a row before the big correction began. And we had this time in 2025, 9 straight up weeks as well, starting right here before we started this correction. Now, the reason why I think we still have to go a little bit lower on gold is that number one, there's too many weak hands in the trade still. Not enough people have been flushed out. The markets just generally want to flush out the weak hands before it bottoms out for its next bull run. The other thing to go over is look at what happened in 79. Where did we pull back to before we started to get a big bounce? The former pivot of the consolidation. If we look at that right here, it's right in here in 1979. We pulled back there, and then we started to move up. Here we have it right in here. And that tells me that we could come back as low as 36 to 3,500 before the next bull move. Now, important here, and this is big because I'm sure you're going to get a lot of comments of people saying, oh, it's different than 1979. You're 100% right. It is different. The difference is in 79 in the 80s, Volcker was raising interest rates. Right now, Powell's cutting rates, right? In 1979, debt to GDP, 32%, 130% now. Now we have a government that just keeps spending money recklessly. Back then, they actually had, bipartisan agreements to make fiscally responsible things. And so the difference here is that in 79, we didn't see those all-time highs again for basically 20 to 30 years, right? In this period now, I think by next year, we're back at all-time highs. And so it is different. It's just the initial emotional reaction will be the same, but then gold should head back to new all-time highs. 5K next year to me is a no-brainer.
It is consolidating right now. What you have to understand is that what really brought gold up is geopolitical. So, I learned that back in the 80s. Gold had gone from 100 to 400 between 76 and 79, but it went from 400 to 875 in the last 6. And what caused it was that's when Russia invaded Afghanistan. So it's always been this, the real strength or backbone, I would say, to gold is, geopolitical. Who's going to survive? That sort of thing. So right now you're getting into this consolidation period. You're not getting a crash because, a lot of people are looking around, there's maybe peace deals, things of this nature. But honestly, none of them are going to really survive. Just in Thailand this morning, a Thai soldier stepped on a mine, and all right, let's go get those Cambodians again. It's around the world. What our computer has shown that yes, we're going into World War III, but this is not like Hitler invading Poland. I mean, this is global. So gold is basically the neutral position. You heard a lot of people saying, oh, gee, central banks are buying gold. Oh, they're bullish. No, they're not. They don't care if it goes up or down. The whole issue is, you can buy Confederate bonds on eBay. All right. Bonds are worthless if the country loses. Who's going to win? All right. I can tell you our computer says Europe will not win. Europe is the worst of all. As you know, I was called in to help create the euro. And I warned them that you have to consolidate the debt if you wanted to compete with the dollar. And Hermann Kohl was the Chancellor of Germany, and he wouldn't allow that to happen because he said before he died, he said if he knew he let the German people vote on joining the euro, he would have lost 7-3. It looks to be after probably January next year. In most of these cases, you're looking at basically a 3-month, consolidation type thing. But our computer's showing war next year, and I think that's going to be the real catalyst, and that's what giving the bid to gold. All right. So just keep that in mind that it's not going to crash and go back down to 2000 or something like that. I don't see that. In order to do something like that, you'd have to have really peace.
The current pullback in gold is shaping up as a necessary reset rather than a structural breakdown, even though short-term pressure may still push prices toward the mid-$3,000s before regaining strength. The historical echo of 1979 remains striking. 9 consecutive weekly surges, followed by a flush that clears weak hands. But today's backdrop is fundamentally different. Rates aren't rising. They're being cut. Debt levels aren't manageable. They're extreme. Governments aren't tightening their belts. They're accelerating spending layer on a rising geopolitical cycle, with global tensions expanding into multiple regions simultaneously, and the long-term bid for gold becomes far stronger than in previous eras. This is why expectations for fresh all-time highs next year, and even a push toward $5,000, are increasingly realistic. Consolidation is emotional. The trend is directional. Let's get into the interview.
He thought the Germans would be upset about consolidating the debt, that they would be bailing out Greece or Germany or Italy or whatever. So he said no consolidation. Now, as a trader, I'm not an academic. I said, look, if you don't consolidate the debt, this is not going to work. And just look at what happened when Greece got in trouble in 2010. And you can read the chapter 1931 in Herbert Hoover's memoir. Same thing. He said capital acted like a loose cannon on the deck of in a tempest, firing off in every which direction. They didn't know where it was going next. That's what you're looking at. Now, because they didn't consolidate the debt, all right, if France goes, needs an IMF bailout, what are the traders going to do? First thing you do is you look at all the banks, because their reserves are individual government debt. There is no federal debt. Okay. So they're going to look at the banks and say, oh, who has the most French debt? Short that one. So you're looking at a banking crisis. All right. Then on top of that, you got a pension crisis because 70% of the pensions must by law have government debt. So that's what I mean. They get into trouble and all these people are going to be picking up their pitchforks and storming their parliament. All right. In the United States, our reserves for banks are federal debt, not California, not Illinois. If California goes bust, the traders will do the same thing. Who's next? Oh, Illinois. Okay. So this is why central banks have been buying the gold. All right. The central banks have lost control. Raising interest rates. Oh, it's going to lower inflation? No, it makes it. Why? Because look, when Keynes came up with that, it was the 30s. U.S. had a balanced budget. So yes, then raising interest rates. Guess what? We were the 99%. Today, we're not. The governments are. So you raise interest rates to fight inflation? Do you really think somebody in Congress says, oh, gee, the Fed wants us to spend less. Let's cut spending? Not going to happen. All right. I mean, so, this is why you have countries, at least the ones on the outside, not Europe, not the US, buying gold, because they are just looking at this, and it's a roulette game. Am I going to bet on red, or am I going to bet on black? You know what I mean? The neutral at this stage in the game is gold. And don't take it that they're bullish. They're not investing. Okay. They don't care if it goes down. They're not going to sell.
Gold's surge from $2,600 to above $4,400 created a powerful rally with almost no deep corrections, but the latest pullback is reminding the market that even strong trends need to breathe. The structure now exhibits a classic consolidation, characterized by slowing momentum, thinning volume as the holiday season approaches, and support levels around $3,960 to $3,930 serving as a technical floor. A deeper break toward $3,900 would still fit within a healthy cycle, but losing $3,680 would signal a shift into a broader bearish phase. Silver's behavior reinforces this caution, with a clean double top above $53 and a series of declining candles now testing critical zones at $49 and $47. Yet, as long as gold holds its base and avoids a lower low, the broader bull market remains alive, only paused rather than reversed. If this gave you value, smash that like button, share it with those paying attention, and subscribe so you don't miss what's coming next. Stay alert, stay prepared, and keep stacking tangible assets.